It's important to understand where we start from. What's the foundation? What are we doing here? What we're doing here is we have identified a crowd behavior pattern in the behavior of the crowd on financial markets that will emerge no matter what. These patterns emerge because we are human beings, and the participants can do nothing about being a human being, so they can do nothing about these patterns emerging. And that's the fun part about it. Even if they didn't want us to see it, these patterns will emerge simply because the participants are human. Now, I can hear you already, and you're saying that much of the trading is done by algos today and machines, and you're right. But the thing is that those algos were also written by humans, and they have a boss too. Wherever they are, they have strict criteria and requirements by the fund management to write those algos in a certain way. So there will be checks and balances written in the algos, which means it will just mirror how a human behaves in situations of hope and fear and greed. So that's why we don't really have to worry about who does these trades, the algos or somebody presses the mouse. It doesn't matter. The patterns will emerge. The only thing that, as we mentioned, is that we do need a crowd. 2-3 people will not create these patterns. We need a crowd. You can dig into the data, or if you want to go scientific about it, you can discover your own unique patterns if you want to pursue that. There's one good one which we have discovered, and not discovered really, but implemented a software around, and that is the reemergence of momentum out of consolidation areas, popularly called as a pullback. So as you can see, there are 2 or 3 variants, or even maybe more. But one thing that you will learn here quickly is that we don't want to get lost in the little details, because it doesn't really matter what the thing looks like. An elephant is still an elephant. Once we identify the pattern, we know what we're dealing with, and the little details are mostly random noise that we want to ignore anyway. So the first one here is what we call a simple pullback. It's just a one zigzag situation. And before you think these pullbacks only happen in financial markets, not really. Actually, in many other situations, anywhere where people buy and sell, these patterns will emerge. If you wanted to map or chart real estate data in, let's say, a big North American metropolitan city where you might be residing, if you want to gather data and put it on a chart like we do with the NQ or RTY or whichever, you will find very similar patterns on the real estate market. And just think about it. Nobody wants to buy at the top. So if you want to buy a house, you will look around, look at the data, and if it's too high, you might wait a little bit till price comes back. That's exactly what people in the financial markets do as well. So it's the same thing over and over again on different markets and different situations, because it's all triggered by how humans behave in a certain situation. So that's a theoretical background. So this is a situation, what we call a simple pullback, just one zigzag. We have to know and be aware of the fact that a simple pullback often transitions or evolves into a complex pullback. That could be a painful experience for a trader, because when this happens, we might get stopped out. Now, one situation that many think as a frustrating situation for us is just business as usual, because when this happens, we know what's happening. And even if when we were stopped out, or if we were stopped out, we're ready to go back in again if momentum reemerges. This situation is not revenge trading. Revenge trading is an absolute no-no. For us, if we get stopped out, if we do go back in, we don't go back in because we want to take revenge. We go back in because a simple pullback transitioned into a complex pullback. And there's reason for us to consider a position again, just to show you that just because a simple pullback became a complex pullback, there's no rule in the universe that prevents the market from zigzagging 3 times or even 4 times. So we get to the point where when there's too much of a good thing, if it comes back too much, of course, we would not really be interested in a long trade at that point. Now, how we're going to decide, luckily, we have found a mathematical solution to decide so that the software can decide when enough is enough and the long idea is dropped. And that's exactly what we're going to talk about next. That's the buffer zone component of the software. And the buffer zone's job, as I already indicated, is to make a decision to decide when the pullback is too deep, too much, the complete loss of momentum has occurred, which makes us not be interested in, let's suppose in this situation, a long trade anymore. But everything I might show you the long side, the same goes for the short side as well. Okay, here's a pullback. The question is, what kind of pullback is too much? Is this too much? Is this too much? If price penetrates, you see this little shady area, this is this white area between the blue line and the shaded area at the edge of the Keltner. This is the buffer zone. And simply what we're doing, if the tail penetrates the buffer zone, touches, goes outside this grayish area, we drop the longs because the chances of a losing trade are just so high that we don't care. We're not interested in going long. Now, I can show you other situations when actually that happened. Here, for example, potentially we were bullish here and we very quickly changed our idea and we turned strongly bearish based on price action. Every time the buffer zone is penetrated, it's important information for us, short or long, and this is done by the software automatically. So first of all, here's a description of the buffer zone, and also there is a chapter devoted, or at least a section devoted in the user guide for the buffer zone. And I want to show you the technical specifications. And here, BT settings explained. And here we go. Buffer zone. I can just search on the page. And right there, activate buffer zone. So here we go. And here it is, trade setups, activate buffer zone. There's no obligation to switch it on. First of all, we never force traders to use a certain functionality. I have the opinion that it's quite useful to have it switched on, because then if you have this switched on, then it will, these situations that I just described here on this chart on the RTY will be filtered out. So that's how it works. And that would improve our edge because it would filter out some of the potentially highly likely losing trades. Let's move on to the next one. The next one is also foundational, because since we trade pullbacks, and since there are two kinds of pullbacks, simple and complex, and that's crucial to know to be successful, we expect the software to be able to differentiate between the two, simple and complex. And the software does that. Our software is able to differentiate between simple and complex pullbacks. And as we mentioned in the previous video, actually, there are traders who only trade complex pullbacks. So with our software, it's possible to not even be interested in simple pullbacks and only trade complex pullbacks. Now, I can already hear you. You're asking me, why would that make sense? Here's why. Because a simple pullback looks like this, but where we enter, it only started to move. And then we enter the market. And what can happen is this, and we get stopped out. Now, however, painful experience that may be, it's a normal behavior by the market. And again, some traders may not be interested in going through these admittedly psychologically difficult situation of being stopped out from an otherwise good trade. So they may just decide to ignore the simple pullbacks and wait. When this comes, they wait. They don't go long. They don't go long. If it goes long, they miss the trade. But if it becomes a complex pullback, then they go long when the momentum reemerges from the complex pullbacks. Now, if you switch that on in NinjaTrader, there's a very easy switch. Let me just hop on Ninja. Hopefully I can. And if you go into strategies again, I'm going to clean this up. Here we go. There is a switch between complex and simple pullbacks. So if you so choose, you can just trade the complex pullbacks. Now, there's no free lunch here. So every time you want to gain something, you have to give up something. So what happens is that if you just trade the complex pullbacks, then you, by definition, you will miss the simple pullbacks. And it's a little painful to see good trades going by and us not being in it. There's always a trade-off. If you trade both the simple and both the complex pullbacks, then there will be situations where you go long and you get stopped out because it turned into a complex pullback. The other solution, of course, is to simply ignore simple pullbacks, which means that when this happens, I'm still waiting. If it goes, I'm not in the trade. But if it turns into a complex pullback, that's when my algorithm, the software, automatically will take the trade. Imagine this is a blue or green arrow, so we're going long here. All right. Now, just know that just because I went long in a complex pullback, it doesn't mean that I cannot be stopped out, because as we have seen, some pullbacks can become a triple zigzag. There's no guarantee that our stop will not get hit. But there will be fewer losing trades because those losing simple pullbacks we have not taken. So let me know if that makes sense. And that is another feature in the software. Most of these concepts have a blog post devoted to them when the functionality came out. So that's another reason to go to Google and just type in complex pullbacks, remek.ca, and then you'll find this blog post. The other source of information, of course, is the documentation itself. All right, so that was the simple complex pullback. The next one is, so we covered these two, and the next one is the trend filter. The trend filter is pretty obvious. We are pullback traders, right? The popular term. So we trade with the trend. We're not interested in counter trend trades. We're not interested, let me just draw it to you. Let's just imagine that this is the Keltner, right? And you can trade two ways, either from the middle to the Keltner, roughly speaking, or from the Keltner back. This would be a momentum trading strategy. This would be a mean reversion trading strategy. With all due respect to mean reversion, and we could do it if we wanted to, that's not what we do here. We choose not to trade that move. That's just a pullback for us. We're more interested in trading the move towards the edge of the Keltner. The point is that we always want to trade in the direction of the trend. So if this guy is going up, we want to go this way, to the upside. And the software is able to do that automatically, of course. Again, in the software, nothing is mandatory. So there is a switch to trade with the trend. And if you have that switched off, then it will be ignored and all kinds of signals will be shown, so that you will have a lot of signals on the chart. Most of us, is not what we want to see. So we always have the trend filter switched on. You have four options. I always receive the question, which is the better, which is best? And I'm saying that the difference, all four are good. And the difference is so small, 5-10%, that it's really not worth your time to really spend a lot of time testing this out. And I'm just okay with this one, ADX VMA. If you want the secret behind the composite is a weighted average of the other three, which means if two of the three point to one way, then the Remek composite gives a true signal. So that's the trend filter, which means that we only get signals in alignment with the trend. So I would suggest we stop here. And we'll have another one next week, and we'll continue covering them all. Then feel free to click on these as well. And it's quite obvious and easy to understand and follow which functionality or which design component does what and why it is in the software. Last minute here, if you go to resources, they're here for a reason. They are really here because they are useful. And make sure you study them, go through them, and have fun doing so, because it all makes much more sense if we have fun at what we're doing. And you can certainly have fun in the markets, and you can enjoy the results if we approach it the right way. Again, thank you very much. It's been a pleasure, and we'll see you soon. Thank you, and mindful trading.